Hey guys, Steve Palise here. What is cap rate and why is it important? Capitalisation rate, or cap rate, is a concept used to determine a property's market value at that moment in time. In simple terms, a cap rate is often calculated as the ratio between the net operating income, the NOI, produced by an asset and its original capital cost, or purchase price. So, if you purchased a property for $1 million and it returned $50,000 a year in net rent, it has a cap rate of 5%. Cap rates are different from cash-on-cash returns because they're based solely on a property's net operating income and purchase price, without adjusting for any debt, mortgage repayments, or purchasing costs such as stamp duty. This means you can do a direct comparison with other properties. Cap rate and net yields are essentially the same thing and are often used interchangeably. The main difference is that the term net yield is used for the net return of a property, whereas investors commonly use the term cap rate to compare the value of commercial properties using their rental yields. Cap rates are useful for doing a quick back-of-the-envelope calculation to compare the relative value of similar commercial properties. But a detailed cash flow analysis should be performed when considering buying an individual property. The cap rate can be used in several ways to help you compare investments and remove the guesswork from buying and valuing properties. And, much like net yields, the cap rate can be reversed to calculate a purchase price for a property. With rental increases and a stationary cap rate, you can also work out an approximate new value for your property. For example, let's say you buy a $1 million property with a cap rate of 7% and annual rental increases of 3%. If the cap rate in the region remains unchanged, you can see that the value of the property will increase considerably with rental increases alone. In 10 years, the property is worth $300,000 more just from steady 3% rental increases. The cap rate varies for different commercial asset classes and the region they are located in, and they're also influenced by the lending environment and the cost of borrowing. There can be many reasons for lower and higher cap rates. For example, cap rates are lower in properties with strong tenants, national franchises, high foot traffic, solid locations such as beachfront, capital cities, or areas with low vacancy rates, because these are seen as lower risk or high capital growth areas. But properties with a higher cap rate may be in a quiet area or a regional town, have low foot traffic, high vacancies, a short lease or a short time left on the lease, be a poor quality tenant or a startup tenant, or in a dying industry. Higher cap rates may appear attractive from the outset, but once you take into account the long periods of vacancy, leasing fees, marketing costs, incentives, and lower capital growth, their net result is usually less. You can find out the cap rates in a couple of different ways. The first one is by asking the property agent. A selling agent or property manager will be able to give you a quick gauge of cap rates because they'll know the area well. To get accurate information though, it is best to speak with the agents who aren't involved in the sale. Secondly, you can find out what the cap rate is by checking sold prices. You can obtain comparable cap rates by checking the recent sales history of similar properties and finding out what the properties were renting for. You can also check local property advertisements. Some agents will advertise the property based on a net yield, which will give you an indication of some competing cap rates. Lastly, you can speak to a local valuer. A local valuer is a great independent source without an ulterior motive. Their job is to check cap rates to obtain an accurate valuation. If you are looking to buy a property, you'll need to match your property's type and location with the best information you can get from the 4 sources in the list. It's unlikely an advertisement will tell you what the property will sell for, so it's up to you to find recent sales to use for negotiation. So there you have it, cap rates, what they are, what influences them, and how to find out what they are. If you know of someone looking into commercial property as a form of investing, make sure you share or tag them in this video. This is Steve Palise, author of Commercial Property Investing Explained Simply. Thanks for watching.